I want you to imagine, just for a second, waking up tomorrow morning.
For just a normal day.
Yeah, normal day. You wake up, you check your phone, and you find out that 20% of the entire world's energy supply has just been erased overnight.
It's completely gone.
Not delayed by shipping lanes, not rerouted, gone.
I mean, the immediate reaction in the financial markets would be pure panic, which is, well, it's essentially exactly what happened.
Exactly. That is the reality the global market woke up to in late February 2026. Because following the U.S.-Israel military action against Iran, we saw the effective closure of the Strait of Hormuz. And even more critically,
Qatar.
right, Qatar, specifically Qatar's Ras Laffan facility, which just happens to be the world's largest liquefied natural gas, or LNG, facility. It suffered severe damage and was totally forced to halt production.
Yeah, and I mean, to put that in perspective, taking out Ras Laffan, it's basically the equivalent of removing a massive load-bearing pillar from the global economy. Because Qatar accounts for roughly 20% of global LNG exports.
Yeah.
So the shockwaves from that single event, they're still rippling outward, fundamentally rewriting the rules of global energy.
And supply chain security, too, which is why mapping out those shockwaves is our mission for today's deep dive.
Absolutely.
We've got this massive stack of fresh market analyses, reports from Wood Mackenzie, the International Energy Agency, the Institute for Energy Economics and Financial Analysis, and we are looking at how this crisis is totally transforming two huge Australian export sectors.
Right, LNG and coal.
Exactly. We'll examine how it's redrawing the map for Asian energy security and why specific regions, particularly the state of Queensland, are suddenly emerging as unexpected geopolitical powerhouses in this new reality.
Yeah, it's a massive shift. And to understand the scale of what actually happened, we have to look at the raw data right after that Qatar facility went offline.
The numbers are insane.
They really are. Asian spot LNG prices just violently spiked. For context, we measure natural gas in MMB2 million British thermal units. And before the conflict, the market was sitting pretty comfortably at about $10.40 per MMB2.
Right.
But at the peak of the panic, that number blasted past $25.
Wow, more than double.
Yeah, easily. It has since settled around $19, but I mean, that is still nearly double the pre-crisis norm. And oil prices surged right alongside it.
Which triggered this massive Australian windfall, right? Almost overnight, Australia gets bumped up from the world's #3 LNG exporter to #2.
Exactly.
But what these sources really emphasize is that this isn't just about total volume. It's about what analysts are calling the reliability premium.
The reliability premium.
Right,
Yeah.
because Australia has this short, 15 to 20-day shipping route straight to Asia and absolutely zero exposure to the Strait of Hormuz.
Well, yeah. When supply chains break down like that, reliability just becomes the most valuable commodity on Earth. Asian buyers, we're talking Japan, China, South Korea, Taiwan, they're looking at Australia and seeing a lifeline that simply doesn't pass through a volatile conflict zone.
Okay, let's unpack this a bit, though. I want to push back on the mechanics of this windfall.
Sure.
Because if we look at the physical limits of the infrastructure, right, Australian LNG facilities, places like the Northwest Shelf, they are already running at over 90% capacity.
Very close to the absolute limit, yeah.
Right. The numbers show they're exporting around 80 to 87 million tons per annum right now. So if the infrastructure physically maxes out, they can't just flip a switch and pump vastly more gas to replace Qatar. So how do they actually capitalize on this?
That's the billion-dollar question, the massive windfall. It isn't actually coming from pumping more gas.
Wait, really?
No, it comes from the structure of the contracts for the gas they are already pumping.
Oh, interesting.
Yeah. See, roughly 75% of Australian LNG contracts are linked to oil prices, and they usually have a built-in lag of about 3 to 6 months.
Ah, okay. So because oil spiked alongside LNG during that initial geopolitical shock, those long-term contracts automatically adjust upward.
Exactly. It generates massive export revenue stability. The price of their existing product just inflates.
And what about the rest of the gas?
Right. So then you have the remaining 25%, which is sold on the spot market.
The open market.
Yeah, the open market where buyers purchase uncontracted gas for immediate delivery. I mean, think of it as the difference between having a fixed-rate mortgage versus having to rent a hotel room during a citywide emergency.
That's a brutal analogy, but it makes sense.
Right. So that uncontracted gas, that 25%, it caught that massive $25 wave.
Right.
And this is exactly why companies like Woodside and Santos experienced like 10 to 16% bumps in their stock prices.
Without drilling anything new.
Exactly. Not a single new well. They just saw an immense value spike on their existing production capacity.
Okay, but there has to be a breaking point for the buyers, right? I mean, when LNG prices literally double, those Asian utility companies are totally backed into a corner.
Absolutely.
If you're managing the grid in, Seoul or Tokyo, you face this brutal choice. You either pay exorbitant rates for gas that will essentially bankrupt your utility company, or you let the power grid fail and the cities go dark.
And no government is going to choose rolling blackouts.
Right.
Not if they have any alternative at all.
Right.
So that desperation forces a massive, immediate shift away from gas to the only affordable backup available that can actually sustain a national grid.
Which brings us to the revival of coal.
Yes.
Because for years, LNG was positioned as this essential bridge fuel for the global green energy transition. It has, 47% lower carbon intensity than coal?
Around there, yeah. And gas plants can be spun up super quickly to support intermittent renewables like wind and solar.
Right. But what's fascinating here is how this crisis acts as a magnifying glass on the vulnerabilities of that whole transition strategy.
Oh, 100%. The whole bridge fuel model works beautifully in peacetime.
Right. I mean, it's like relying on a state-of-the-art smart heater.
Right.
But then a massive blizzard rolls in and knocks out your Wi-Fi.
Yeah.
You don't just sit there and freeze. You start throwing chopped wood into the fireplace. You don't care about the smoke. You just need the heat.
That's exactly what's happening. When the bridge collapses due to geopolitical risk, survival instincts completely override environmental targets.
We're seeing it everywhere.
We really are. We are seeing a frantic, large-scale revival of coal all across Asia.
Yeah.
South Korea officially delayed the retirement of its older coal plants.
Wow.
Thailand ordered its largest coal plant to run at absolute full capacity. Japan, China, the Philippines, Bangladesh, Pakistan, they are all ramping up coal generation just to protect grid stability.
The projections from Wood Mackenzie capture this shift perfectly, by the way. Before this crisis, they projected that Asian LNG import growth for 2026 would be around 12.4 million tons. Post-crisis, they slashed that projection down to just 5 million tons. That leaves a massive gap in energy needs.
It does. But we need to be very precise about how they fill that gap, because they aren't just buying any coal on the open market.
Right, there's a huge difference.
Yeah. The type of coal required by these massive Asian economies, it actually reveals a deep stratification in the global market. And it perfectly plays into Australia's unique geological strengths.
Because, okay, if I'm an Asian utility manager, right, and my budget is totally blown because of LNG prices, why wouldn't I just buy the absolute cheapest coal available?
Which is what a lot of people assume they do.
Yeah.
Yeah.
If we look at the regional supply roles, Indonesia is sitting right there, right next door, basically, exporting massive volume, over 500 million tons a year of coal.
Right.
Meanwhile, Australia exports less than half that, around 200 million tons, and charges a premium for it. So why are these Asian utilities fighting over the more expensive Australian product?
Basically, because they physically can't burn the Indonesian product in their power plants.
Oh.
Yeah. Let's look at the engineering behind what's called the Newcastle benchmark. That's the standard for Australian thermal coal. Australia produces high-end thermal coal, meaning it burns at 6,000 plus kilocalories per kilogram.
Right.
But more importantly, it has extremely low ash and low sulfur content.
So it burns hotter and leaves less residue.
Yes, exactly. And when premium markets like Japan, South Korea, and Taiwan switch away from LNG, they are using these highly advanced, ultra-supercritical power plants.
Right, because they have strict environmental laws.
Yes. Incredibly strict environmental standards and high-efficiency grid requirements. So putting cheap, high-ash, low-grade Indonesian coal into one of those modern boilers, it's basically like putting low-octane, dirty fuel into a Formula One engine.
It just ruins it.
It clogs the emission scrubbers, it wreaks havoc on the internal machinery, and the overall efficiency just plummets. They literally require high-efficiency, lower-emission coal to meet those standards while keeping the lights on.
Oh, wow. So Australia isn't competing in a race to the bottom with Indonesia for volume.
Not at all.
Because global coal prices are rising across the board, Australia is uniquely capturing the high-value market share of these advanced nations that are desperate for quality fuel switching. They're essentially selling the premium emergency backup.
Exactly. And this market divide heavily favors the exact product Australia pulls out of the ground. But it also creates a fascinating economic split within Australia itself. heavily favoring specific states over others.
Here's where it gets really interesting. You have this dual boom happening simultaneously, right? Record value in LNG and record demand for premium coal.
Right.
Now, if we look at Western Australia, they have immense LNG infrastructure advantages. Projects like the Northwest Shelf, Gorgon, Pluto, these are world-class LNG facilities. So Western Australia is reaping massive rewards from the gas price spikes.
Yeah, Western Australia is an absolute LNG heavyweight. They're insulated by the sheer scale of their gas export capacity. But Queensland,
Queensland is pulling off a massive dual victory right
that
now.
is incredible.
Because Queensland isn't just an LNG exporter. It is a total powerhouse in the exact premium coal that the Asian market is scrambling for.
Right, and we should define the coal output there, because the sources specify Queensland is booming in both premium thermal coal and metallurgical coal.
Right, thermal coal is what we just discussed. You burn it to boil water and spin steam turbines for electricity.
Yes, but metallurgical coal, that's used in blast furnaces to actually make steel.
And right now, global supply chains are in a state of panic.
Absolute panic.
So nations are rushing to build out localized infrastructure to, secure their own economies, which demands massive amounts of steel.
Exactly. So Queensland is perfectly positioned to supply both the energy to run the grid and the raw materials to build the infrastructure.
It's a perfect storm for them. And it really highlights how state-level policy and resource diversity create resilience. Because before this 2026 crisis, Queensland's established coal infrastructure was viewed by a lot of analysts as like a sunset industry.
Yeah, something that would slowly wind down as the green transition accelerated.
Right. But today, it acts as the ultimate economic shock absorber. A region reliant on a single resource is highly vulnerable to global price crashes. But Queensland's dual-engine economy means they are insulated and currently exponentially benefiting from all this global volatility.
Yeah, the state government's policy of maintaining the resilience of that coal infrastructure rather than aggressively dismantling it prematurely, it's paying off in billions of dollars of unexpected export revenue.
But of course, that massive influx of wealth creates a treacherous domestic tightrope for the federal government.
Oh, it's a political nightmare.
Right, because put yourself in the shoes of an everyday Australian citizen. The country is making billions upon billions of dollars exporting energy to Asia, but because those global prices are interconnected, the domestic natural gas and electricity prices inside Australia are facing severe upward pressure.
Right. Everyday consumers are sitting there watching their own power bills spike, while energy companies are announcing record profits.
It creates a severe policy challenge. The federal government has to balance staggering export revenue with domestic energy price controls, which is why there are these fierce debates right now about the political feasibility of implementing federal windfall taxes on resource exporters.
Yeah, the windfall tax debate is huge. And the argument for it is fairly straightforward consumer protection, right?
Yeah, the logic is that these resource companies are benefiting from a geopolitical crisis they didn't cause and infrastructure damage they didn't suffer.
Exactly.
So proponents argue that a portion of those excess, totally unexpected profits should be redistributed to stabilize the domestic grid and basically subsidize the power bills of citizens who are just caught in the crossfire.
Right. But then the opposing argument focuses on the mechanics of long-term corporate investment. Because the resource sector, it operates on massive capital-intensive projects that take decades to build and pay off.
Right. You don't build an LNG facility overnight.
No, you definitely don't. So opponents of the tax argue that if you penalize companies for global price spikes, but you don't subsidize them during global price crashes, you destroy the fiscal certainty they need to actually authorize future infrastructure.
I mean, I understand the consumer protection angle for sure, but looking at it from the corporate side, how does a CEO justify pushing forward with new projects?
That's the problem.
If global supply chains are this volatile, literally shifting 20% overnight, and you might get hit with an unpredictable windfall tax at home, how do you plan for the next 10 years?
You can't.
Right. You can't authorize a $20 billion LNG terminal or a new critical mineral mine in an environment where your upside is capped by sudden taxation.
And the result of that uncertainty is hesitation.
Yeah.
And that hesitation fundamentally changes the investment horizons for a major energy project.
It sells everything.
It does. The threat of windfall taxes, combined with immense geopolitical volatility, creates a highly uncertain environment. It risks chilling the exact investments required to secure long-term energy supply.
Wow.
Because if companies stop building now, it practically guarantees worse supply shortages and higher prices a decade down the line.
Which leads us to the ultimate question regarding long-term strategy. What does this 2026 Middle East crisis actually do to the global green energy transition?
That is the big one.
Yeah. In the short term, the reality is a clear delay. By firing up old coal plants and prioritizing emergency fossil fuels, Asian decarbonization timelines are unequivocally shifting backward right now. Emissions for 2026 and 2027 will be significantly higher than projected. Energy security mandates are completely overriding green energy goals.
Yeah, the short-term delay is undeniable. But if we connect this to the bigger picture, the long-term impact presents a really fascinating paradox.
Okay.
Because while this crisis extends the fossil window and shores up coal demand for the rest of the decade, it will likely accelerate the ultimate permanent shift to renewables.
Wait, really? Walk me through the mechanics of that acceleration, because right now the data shows everyone is buying coal and gas as fast as they can load the ships.
Right now, yes. But consider the trauma this crisis inflicted on Asian policymakers.
True.
They're realizing that relying on imported fossil fuels, even from highly reliable premium partners like Australia, it leaves their entire national economy at the mercy of global choke points.
Right. Whether it's a conflict in the Middle East, a shipping lane dispute, or just an unexpected facility failure. Importing fuel means importing vulnerability.
Exactly. The definition of energy security is fundamentally changing.
It used to mean having a diverse set of global suppliers so you weren't dependent on just one country.
Right. But now, the realization is that the only true security is not needing a supplier at all.
Wow.
This is spurring a massive reevaluation at the highest levels of government across Asia. The ultimate way to ensure absolute energy security is domestic renewables paired with massive utility-scale battery storage.
Because sunlight and wind don't travel through the Strait of Hormuz.
Exactly. And they don't carry a premium based on geopolitical panic.
But building a utility-scale battery grid isn't just like plugging a city into a giant lithium battery, right? It requires massive infrastructure overhauls, grid-forming inverters, and an entirely new supply chain of critical minerals like lithium, cobalt, and copper.
Oh, it's an incredibly difficult multi-decade engineering challenge.
Yeah.
It is deeply complex.
Yeah.
But the pain of paying double for LNG and scrambling for premium coal, it provides the ultimate financial motivation to overcome those hurdles. Asian energy security mandates are shifting to prioritize the rapid development of those localized grids.
They're willing to spend billions now to ensure they never face this kind of supply hostage situation again.
Precisely. Which brings up a critical stranded asset warning for Australia.
Right.
Because Australia is enjoying a historic economic boom right now, obviously, cashing in on the premium coal and gas panic. But if they assume this boom is permanent, analysts warn they're making a fatal miscalculation.
Because if Japan, South Korea, and Taiwan successfully accelerate their domestic independent grids, their long-term demand for imported coal and gas will permanently drop after this current panic subsides.
Yes. Australia risks holding massive stranded assets. They could end up with billions of dollars invested in coal terminals and gas extraction facilities, but with a shrinking pool of buyers.
So the consensus from the sources is that Australia must use this narrow, incredibly profitable window to fund its own transition.
They absolutely have to.
They need to take the windfall from the current fossil fuel panic and aggressively invest it into critical minerals, green hydrogen, and domestic renewables.
Right. They have to leverage their current status as a premium fossil fuel supplier to build the infrastructure required to be a clean energy superpower.
Because if they fail to reinvest this windfall and simply rely on the current export revenue stability, the economic consequences will be severe a decade from now when Asian demand fundamentally shifts.
A very small window of opportunity.
It is incredible how interconnected all of these systems are. I mean, to recap the journey of this deep dive, a military conflict thousands of miles away in the Middle East effectively erases 20% of the global LNG supply overnight.
Right.
That instantly doubles gas prices, completely altering the contract dynamics for suppliers. The sheer cost forces major Asian economies to pivot backward to coal just to keep their grids alive.
Yeah.
But because their infrastructure is highly advanced, they can't burn low-grade alternatives, which specifically targets premium Australian coal. That creates a massive dual-engine economic boom for the state of Queensland.
The shock absorber state.
Exactly. But back home in Australia, that boom triggers fierce domestic debates about windfall taxes and long-term corporate investment. All while the crisis itself secretly accelerates the ultimate desire for complete green energy independence in Asia.
It's wild. It perfectly illustrates how energy is the true foundation of global geopolitics. Every sector, every supply chain, and every political decision is touched by it.
And that is exactly why this matters so deeply to you listening right now. Energy security isn't just an abstract concept modeled by economists.
Not at all.
The device you're listening to this deep dive on, the heating in your home, the prices of the food at your grocery store, the global economy you participate in every single day, it is entirely dependent on these fragile, invisible supply chains we just spent the last 20 minutes unpacking.
Yeah, we often take the flick of a light switch for granted without realizing the immense global machinery required to make that simple action possible.
And the vulnerability of that machinery has never been more apparent than it is right now.
Absolutely.
So I want to leave you with one final provocative thought to mull over. We've talked extensively today about how this 2026 crisis is forcing the world to return to coal in the short term. But consider this from the perspective of an Asian policymaker. If you just had to stand up and explain to your citizens why their power bills tripled and why their factories faced rolling blackouts because of a conflict 5,000 miles away, wouldn't this be the exact moment you decide to fundamentally redesign your national grid?
It's the perfect catalyst.
Right. Not just to meet arbitrary climate goals, but so that your country never, ever has to buy a single shipment of imported fuel, coal, or gas ever again. What happens to the global energy map when the biggest buyers decide they simply don't want to play the game anymore?
It is the question that will dictate the next 50 years of global economics.
Definitely something to think about the next time you turn on the lights. Thanks for joining us on this deep dive. We'll catch you next time.